If you're solely relying upon rules of thumb to base your retirement plan on, you could be in big trouble. My name is Dylan Martin, certified financial planner. If we haven't gotten to meet yet, I work with Stewardship Investments. We specialize in working with Christian families to help them retire well and to be good stewards. In general, rules of thumb can be very helpful as a starting point and as a guide to really just get you going, but if you are fully relying upon those when you're doing your research to build out your investment plan or retirement plan, then following those blindly could lead you into big trouble, and I'll explain why. First rule of thumb, very popular, it's the 4% rule that gives you a gauge as far as how much money you can be withdrawing from your investment portfolio. It says at the beginning you can be withdrawing 4%, and then you add 2% onto that amount each year for inflation, and that is designed to last 30 years. And there are various other assumptions with the 4% rule. I will leave a link below so you guys can check those out, look at all those assumptions. But some of the issues here with the 4% rule, again, it's a really great starting point, but real life and your retirement are going to be much more dynamic and flexible than the 4% rule actually is. It's a very rigid rule in its assumptions, so you could actually not be spending enough, or you could be spending more if you wanted to in years where your investment portfolios, say, are doing well. And then if you're following this rule, you could be spending too much money in years that your portfolio isn't doing well. Of course, if your portfolio is diversified and you know which investments are you taking the money from, you can help to mitigate that and mitigate that sequence of returns risk, but you have to know how to manage that. The 4% rule here also doesn't take into account that, for one, people typically don't really know what they're going to be spending in retirement. I would say that a lot of people underestimate what they're going to be spending. They think they're going to be spending less once they get there, but they actually tend to spend about the same, maybe even a little bit more, as they are traveling, doing different things that they haven't been able to be doing while they're working. But then as the families we're working with, and very typical for retirees, as they are aging, they're spending less. So they start out high, start to spend less. It's not necessarily a static, gradual increase that the 4% rule assumes. The 4% rule also doesn't necessarily take into account if you have any pensions or rental income, any other various sources of income that can be supplementing your retirement as well. You would need to do the step in doing the math and understanding how much you would be needing net from those sources. And that's just another planning step that not everyone is going to be taking. They may think that they need $80,000 in retirement, so they need to account for having the necessary amount there invested, when that's not necessarily the case if you have these other sources of income. The next rule I wanted to break down, it is the sister rule, I guess, in a sense, to the 4% rule. It's the 25x rule. So it's another general rule of thumb that you come up with roughly how much you're going to be spending in retirement, and you times that amount by 25, and that is what your portfolio value should be at when it comes to retirement time to last you for a rough 30-year retirement. Again, like I said with the 4% rule, one of the issues here is that a lot of families underestimate actually what they are going to be spending once they get to retirement, and then that spending is much more dynamic. Two things, these two rules, the 4% rule, the 25x rule, another thing they can't really take into account because they're just a rule of thumb and very static in and of themselves, is what if big expenses come up? I like to tell the families that I'm working with, it's really not a matter of if a big expense is going to come up, it's really just a matter of when. We want to make sure that we're accounting for and making sure there is some flexibility in the plan. And these rules of thumb can't take into account, one, your personal situation and any flexibility you may be needing. Another big, I would say, pitfall in a sense with these rules is that they assume that whatever amount that you are taking as your expense per year is accounting for the investment fees and the taxes that you would be paying from those distributions, say that they're coming from a taxable account. So let's say that expense-wise you're going to be needing $50,000, you're taking $50,000 from your traditional IRA. If that $50,000 is the number that you're actually going to be needing for your day-to-day expenses, you're actually going to be needing more than that. That distribution will need to be bigger than that $50,000 to account for the taxes that are coming. And another piece here is that a lot of times investment fees for people can be more than they think they are. And if those fees are higher, they can eat at that balance of your investment account unknowingly, and then further kind of eat at that nest egg, kind of hurting that longevity of that account. So you would just want to make sure that you're taking that into account when you're having that number that you're coming up with for your expenses. And you would really just want to make sure that the advisor that you're working with are able to provide a high level of value that is making up for the fee that you were charging. It's really just like anything else that you would be looking to purchase or pay for in day-to-day life. The value that you are receiving from XYZ thing that you're paying for should be worth it. And that is the same here with working with a financial advisor. Next, wanted to break down that it's a good general rule of thumb to save 10 to 15%. To be honest, I don't hate this rule of thumb. I really do think it's a great starting point for people. But again, it should take into account your personal situation. For some people, if you're making really high six figures, your income's in the millions of dollars, 10 to 15% with your lifestyle may actually be just you may just be saving way too much. And then on the other side of things, if you have a very modest income, but you're maybe planning for a little bit of a higher standard of living in retirement, you need to be saving maybe more than this 10 to 15%. It just depends on the situation. And just overall, this rule of thumb doesn't take into account what sort of lifestyle you are going to be wanting to live in retirement and when you are going to be wanting to retire. So you may need to be saving more if you're planning on retiring early, or if you're planning on working later, you just really enjoy what you do, you may not even need to be saving this much. So it really just depends on the situation for you. Lastly, I wanted to break down a rule of thumb that is out there that helps to gauge how people are actually investing their portfolios. It's the 100 minus your age rule. And that rule speaks towards how much of your portfolio you should have exposed to the stock market, and then the rest of it being in conservative assets like bonds and cash. So how it works is, let's say you're 40 years old, you would do 100 minus 40, that gives you 60, so in essence 60% of your portfolio should roughly be invested in the stock market. So the rest of these rules of thumb that we've walked through, the 4% rule, the 25x rule, saving 10 to 15% of your income, I really don't think they're the worst. I think they're great starting points. I will say though, this rule I really don't like. I think it's very outdated and honestly really shouldn't be out there anymore as a recommendation for people. So with this rule being outdated, it used to be fairly, I guess, helpful in a sense and popular when people were going into retirement only living 5 to 10 years. The portfolio being so much more conservative made sense because they were going to be needing that money and it wasn't necessarily needing to last that long. Nowadays though, with people having retirements that are 20, 30, 40 years long, you need to have a portfolio that is invested typically a bit more aggressively than this rule likes to promote. And in my example earlier, so someone who's 40 years old, let's say they're wanting to retire at 65, they still have 25 years till they're going to retire, and at 40 they're going to have 60% of their portfolio in stocks and then the rest of it in the more conservative assets, bonds and cash, and their portfolio is going to keep getting more conservative as they age. But they still have a long time horizon until retirement. They could afford to be invested a bit more aggressively with that long of a time horizon to just take advantage of those more quote-unquote aggressive assets in the stock market, because those are going to most likely appreciate more over time, at least they have. And again, this rule just doesn't take into account you as a person. You may be someone who doesn't like there to be really much risk on the table at all. So 60-40, a 60-40 portfolio could be even more aggressive than you would even like to be. Or you could already have enough saved up for retirement and you're kind of in preservation mode. You might want your portfolio to be even more conservative in a sense. But then on the flip side of, like I was saying just a second ago, if you're someone who wants to be a bit more aggressive or you have a longer time horizon, this rule will not make sense for you. Your portfolio will want to be invested a bit more aggressive. So overall, the point I'm trying to make here is your portfolio, your financial plan, all of these things really should be tailored around who you are as a person, who your family is, and what your goals are. All these rules are just very static. Like I said, great starting points, but they can't take into account and handle the full picture that is your life and your planning. I think you should keep doing your research, keep learning about these rules of thumb. I really do think they are great starting points. But when you really are getting down to the nitty-gritty of building out a plan, I think you have to take the next step to go beyond these rules of thumb, to take into account what your goals are and the fluidity of life. And if that's something you need help with, you should look to work with a certified financial planner either in your area, or if you want to explore working with our firm, we'd be happy to walk through your situation with you and help to tailor some of these rules of thumb more specifically to your family and your plan, your goals. And if you're currently following some of these rules of thumb and you're curious to see if you are on track for retirement, make sure to go into the link in the description below to our website. You can take our 2-minute quiz just to see if you're on track for retirement. And for others of you who are needing help with your planning, you want to walk through how to make things a bit more personalized for you, you can click into that link also and schedule a call with our team as well. And like I said before, we'd be happy to help any way that we can.